Friends, this session is something which many of us have been waiting, and a topic that has been in our minds since now many weeks. Let me request Mr. Mohit Khanna. He is the Chief Executive Officer of Macaster, and he comes from a family of lawyers and a practicing lawyer earlier before joining Macaster. Mr. Mohit Khanna will chair the session, introduce the speaker. Mr. Khanna.
Dr. Sangeeta Menon, members of the faculty, and my dear colleagues. Well, we have been hearing since yesterday that NIAS has a tradition to have one of the best speakers available for the participants. And I think in keeping with the said tradition, we have today with us Dr. Narendar Pani, who would be speaking on the topic global financial crisis. And I think in the present scenario, this is one topic which would be of interest to all of us, more particularly in the present circumstances. Dr. Narendar Pani is an economist by training. He has over the last 30 years written extensively on a variety of subjects. Dr. Pani is the author of Inclusive Economics, Gandhian Method and Contemporary Policy, Redefining Conservatism, an essay on the bias of India's economic reforms and reforms to preempt change. Land legislation in Karnataka. He has published a number of academic articles in India and abroad. He is also the author of an explainer on the WTO, 2 novels, a booklet on theatre, and several other articles on the editorial pages of the newspapers. Indeed, a multifaceted personality. So it is our pleasure to welcome Dr. Pani for his address, please.
Thank you, and it's a pleasure to be here today, and I intend to make full use of this opportunity to benefit from your insights and your experience in discussing an issue that all of us are in many senses very concerned about. The issue that I would be looking at, all of us are familiar with what has been happening around us with the global economy, but there is a certain subtext in that discussion of the global economy or the global financial crisis that doesn't always come out into the open. And I thought if we could spend the next 1.5 hours trying to understand that, we could perhaps help us get a greater insight into this. This subtext, I think, is best captured by the differences in the perception of the global economy itself. On the one hand, we have a perception which is dominated by left thinking and not just the left, several others, where you see the global economy as a single system and dominated and controlled entirely by the United States. In that kind of a perspective, anything that happens in the United States immediately affects the rest of the world instantaneously. If the United States sneezes, the rest of us catch a cold. So that it's a complete and sort of completely integrated immediate system. On the other hand, you have a perspective, a perception that sees the United States as undoubtedly the world's largest economy, way larger than anybody else at $30 trillion. It's also a massive influence in a number of ways. And yet, it is just, if you like, the epicenter of the global economy. Ultimately, what happens there has ripples across the world. But nevertheless, it's not an immediate or automatic sort of effect. I think this distinction might look very esoteric or academic at one level, but in actual fact, it is not. And it is not simply because it defines our response to the crisis. If the global crisis or the global economy is just a matter of complete American domination, which nobody else can decide anything else, then the only option you have when the crisis unfolds is to go away somewhere, hibernate, and hope to get back to the world economy when things are better. But if the global economy, if the United States is just the epicenter of the global economy, with wide-ranging effects, but nevertheless different effects at different points of time, then what we need to do is understand what those effects are, see if any of them even have a positive dimension to them, and then work out a much more sophisticated dynamic response. I think the way I posed the question, in a sense, defines or the way I see this particular choice. I clearly am heavily biased in favor of the second view, that essentially the United States must be seen as an epicenter. I think, in fact, one would, I think the people from the members of the Ministry of External Affairs here, and one would in fact argue not here, but in a different context, that essentially the same is true of the global strategic situation as well, and not just the economic situation. But that's, as I said, is the way I see things. And what I would like to do over the next 40 minutes or so is to just outline the series of events, look at the series of events in a way to justify why this is the case before coming back to this basic question and leaving the debate open to you on whether we need to see this crisis as a result of a system that's collapsing, or do we need to see it as a crisis that is a kind of a disease at one point which is having an effect all over. So what I would like to do is basically take us through facts that we all know, but in a way to go through it in a sequence so that we know exactly how this crisis came about and what its implications are before we get back, as I said, to the original debate. I think to begin with the story, and I think we all know that the story begins in the United States, because right until the American economy collapsed, the rest of us we were talking about 10% growth rates and feeling quite comfortable with it. So clearly the problem begins with what happened in the United States. In fact, we need to go back a step further and say it begins with the period when the United States appeared to be doing very well, but at the same time was generally building a crisis. And I think this is best captured by a period or a kind of a time when marketing got ahead of the economy. I think most economic textbooks treat marketing as if it's a subpart of the economy. But I think those of you from industry here would know that there are really two very different approaches to the economy. When you're looking at marketing, we are looking at trying to sell something at a price that is as rewarding as it can get. Whereas an economist would tend to look at it much more in terms of the price that the market can absorb. Marketing tends to push, you tend to compete much more, and offer concessions, sometimes taking you to people who don't always deliver what you would like. For instance, the common idea of the winner's curse, where people outbid each other in order to get a contract, only to find out that the person who has won is really lost because the contract, what he has given to get the contract, makes the whole process unviable. Right? So marketing functions in those terms, whereas economists at least should function in a way that's much more holistic. And there was a time when there are times when marketing gets ahead of the economy due to intense competition, and this happened in the American housing market. The American housing market, the story starts a little earlier, when in the Bill Clinton era, when they decided that the poor must also get access to housing, which is a very laudable kind of hope. And that, in order to pursue that, they said you have to give loans, weakening the criteria that banks would normally use. So you were really going to what they call the subprime borrowers, reaching out to them and offering them housing loans. As a result of this process, you had a huge growth in the demand for housing. Right? And this growth in the demand for housing pushed up house prices. And when the price of houses went up, there was another quirk in the American financial system that came into play, and that is that you are allowed to borrow on the basis of the value of your house. Out here in India, if you went, I think there are people from banks here, would tell you that unless you have, your loans are determined by your earning capacity, whereas in the United States it was also determined by the value of the house. So when the prices of the house went up, people could go in for a second mortgage, could take in another loan, and therefore become even more indebted on the same asset, based entirely on the housing prices, leading to what was essentially a housing bubble. You have a hugely priced, overpriced kind of a market with a housing bubble. Now, people will always say, this is so obvious a point, how come nobody saw it? Right? Why did everybody just ignore the fact that this was a bubble? And the reason they did it once again is because when you're in marketing, your job is not to think of the economy as a whole. Your job is to sell as much as you can. So if you say, all right, it's a bubble, do I exit and wait while other people are making use of it? Or do I say, okay, it's going to burst sometime in the future, but until then, let me get what I can out of it? And most marketers will tell you that the main strategy should be to get what you can out of it and not exit too soon. But when you do that, you know there is a risk involved, and you try at that point to try and protect yourself in some way. And one of the ways to do it, as once again the banking people here know better, is essentially through derivatives. Because it comes from an earlier idea that if each market is seen as a separate element, if I mix them up, I can reduce my risk. If I'm in the housing market, there's a certain risk. I'll say, all right, let me say I don't pay this back just in terms of the value of the house. I link it to what's happening in some other market, right? Like say the oil market, the food market, some other market. When I build a sort of derivative like that, an instrument like that, I think I'm safer because you don't think both will fall at the same time. And if the housing market collapses, it doesn't matter, the oil prices will be high, that will take care of me. So I just mix different markets and come up with instruments that reach out to different markets on the assumption that different markets will not collapse at the same time. Now, this works very well if you just believe that they are separate, if all markets are separate and their prices are determined independently. But this has changed primarily because of the rise of speculators. Now, speculators, in common parlance, might have a very a kind of negative connotation, but in economics, they are an essential part of the economy. For the simple reason that speculators are the only ones who are interested in buying and selling risk. Right. So if I'm a farmer, let us say I'm going to sow a crop today, I don't know what the price will be in December. I don't like the risk. I still want to just decide I'm going to sell it. I sell it for a future price in December. Somebody will come at what they'll give me in December. But when I do that, I'm clearly making I'm selling my risk to a speculator. And since the speculator buys it, I can go ahead comfortably and do my job of production. So a speculator has a critical role in the economy. But what happens with a speculator also is that they have a huge multiplier effect on their resources for one simple reason. That is, that if I'm a buyer like any one of us, enter a stock market, I have 100 rupees, I buy a 100 rupee share. If I'm a speculator, I can decide that all I need to do is make up in my mind that if I make a loss of 1 rupee, I'm selling. In which case, I can buy a 100 rupee share, being clear in my mind that I'll sell at 99 rupees. Right? In other words, with that one decision, the amount of capital I have with me increases 100 times. Right? Now, if I decide I'll sell at 99 rupees and 90 paise, it increases 1,000 times. Right? Now, add to that the fact that I can make multiple deals in a day. Right? It gets even bigger. The multiple gets even larger. Add to that the fact that I get completely globalized and I can make deals in different markets across the world instantaneously. And you're talking about a huge so speculators then become bigger. And the turning point was 1985, when the George Soros, the speculator, decided to push down the price of the pound. The British government, then the Bank of England actually, decided that it's going to stop that process and kept buying the pound to prevent its value from falling. 10 billion pounds later, it was gone. They had the pound was still falling, and then they just dropped out. Ever since then, the governments have realized they cannot stop a speculator attack. All that they can do is hope that they can put one speculator against another by talking up the market in some other direction, getting others, and get them to sort of balance each other out. So what you're saying then is that speculators become an end to themselves, and speculators are operating in more than one market. In other words, that original risk sharing, saying that each market was separate and if one market goes down, the other one will not, breaks down. Because what speculators do is that they invest in one market, then they invest in the other, and then as the markets fall, they fall correspondingly in all together. When they rise together, and when they fall together, because derivatives have linked all those markets. So the basis of derivatives, the original assumption of derivatives, that it will reduce risk, breaks down. Right? So you have a situation then that the whole attempt to postpone risk through derivatives is no longer there, but you have a large amount of investment in derivatives, and there's a boom in the financial markets. Right? That boom in the financial markets creates a huge amount of financial resources. Your financial companies are doing very well. There's a boom in credit. The boom in credit leads to opportunities to spend across the world. So you start investing not just in your home country, but across the world. And you have a globalization of the boom, and you have high growth rates, which once again is spread out across the world. So you have a boom based upon a very, very fragile foundation. The whole story starts with loans that cannot be repaid, and yet are being made into a huge economic success. Necessarily, over time, as probably only to be expected, the bubble has to burst. People finally find that they cannot repay a loan. So when they don't repay their housing loans, there is a default, and when they default, the banks foreclose those loans. When the banks foreclose the loans, they take over the houses. Now they have to get rid of those houses if they're going to make anything out of it, so there's an increase in the supply of those houses. When they do that, the price of houses falls. Right? So as the house prices fall, the value of the assets that the bank is holding also collapse. Right? Now you're given a loan to people first time, second time, based upon the marketing value. Now suddenly you find that even if you foreclose that loan, you're not able to, it has no meaning, because the value of that house itself has collapsed. So you end up with banks' assets collapsing, and when they do that, their lending to the rest of the economy declines. And when the lending to the rest of the American economy declined, obviously industries began to slow down, jobs were lost, and when jobs were lost, people who had taken loans based on also, among those who lost jobs, their ability to repay loans also declined. So you had further defaults, and the crisis got a momentum of its own. In that kind of a crisis, the banks began to sell assets as fast as they could to meet their commitments. In the process, the prices of derivatives collapsed, and when that happened, the stock markets, since the banking companies collapsed, you had, of course, Lehman Brothers or others, the giants were supposed to be too big to collapse, all of them collapsing. Citibank got into trouble. AIG was in serious trouble. So suddenly you have a situation where all those investments collapse. In the process, the demand for industry also collapses, and with it, you find manufacturing companies led by the auto majors also facing a complete collapse. So General Motors, one of the classics, one of the great stories of industrial that are given in marketing stories about industry or in any management course about industry, is now on the verge of collapse and dependent on a government breakdown. Now, clearly you can see here, in this whole collapse, what is the effect on the rest of the economy or the rest of the world? On the face of it, the collapse, because of the interlinking of markets, the collapse in the United States also meant a collapse in all those markets where the price speculators had pushed up prices, including essential commodity markets. The most striking of this was, of course, the oil sector. If you look at this chart, the federal funds rate, when the federal funds rate was high, people kept away from oil. As the federal funds rate began to drop, you find oil prices shooting up, and as you all know, it reached $147 a barrel at a peak. But the moment the financial markets collapsed, the reverse happened. And you find oil prices collapsing equally rapidly. Right? The NYMEX crude yesterday, I think, was $34 a barrel. So you really find a complete, you can sort of, in a way, it's a relief, but all the same factors that pushed up all the commodity prices last year are now working to push it down this year. Now, this involves a huge impact on speculators as well. And one of the elements of speculation that I think, once again, we have somebody from Ministry of External Affairs may be able to tell us more about, is that the speculator process was largely unregulated over the last 10 years, particularly after globalization, because you didn't come under sufficient controls at different points. So as a net result of that was a large part of speculator funding was going in to other activities, the criminal activities. There was a globalization of crime, and of course, the terrorist activities. I, for one, as I said, it's still a level of speculation if I were to say this, but nevertheless, I believe that the link, the empirical link that you can see between the global economic crisis and the collapse of terrorist groups, whether it's the LTTE or other groups, is not accidental. Because in some sense, the global economic crisis has hurt their funding process as well. So clearly one sees a picture here that's not 100% negative if you look at it. In the sense, there's some relief in terms of oil prices that are coming in. But that relief is just certainly not enough to overcome the many effects that it has on India. To begin with the direct effects, one of the elements of the economic reform process has been to make your stock markets internationally, to integrate the stock markets internationally. Right? Companies have been listing abroad, and within India too, you had a complete concentration of the stock markets in just two main markets, Nifty, the National Stock Exchange and the Mumbai Stock Exchange. So you have just these two markets. If you compare this to the first time, if you look at the traditional Indian growth in the stock market, it happened between 79 and 83 was the first boom in the Indian stock market. When there was a changing pattern, the middle class was willing to invest. You had new companies listing in regional stock exchanges all across the country, and then getting capital from that and taking off. So the average size of a public issue then was about 4 crores. You name the major giants of today, they all started small at that time, whether it was Reliance, whether it was Dr. Reddy's Labs. Infosys, of course, started a little later. But any of them, or even Wipro moved into the stock market at around that time. They tapped that. The growth is perhaps best captured by the figure for IPOs. In terms of fresh public issues, in 1979 it was around 50 crores. By 1983 it was 3,500 crores. That was a kind of a growth in your capital market, but it was completely internal, based upon internal savings. Right? After the reforms, what happened was that the local link between local industrialists and the stock market broke down completely, to the extent that all the regional stock exchanges were forced to close down or to convert themselves into nothing more than essential members of the Bombay Stock Exchange. For instance, Bangalore Stock Exchange was once a stock exchange that saw companies like Infosys come up first with its, it was in the sense the birthplace of companies like Infosys. But today it's nothing, it's just another member of the Bombay Stock Exchange. There's no direct listing trading in the Bangalore Stock Exchange. And this is true for almost every regional exchange in the country. Right? So what happens as a result of that process is your entire stock market activity becomes dependent on foreign markets. Right? Even your raising of capital has to be of a size that foreign markets will find interesting. The average size, as I said, in the 80s was 4 crores. Today, it's about 450 crores of a public issue. Right? It's considered a relatively small public issue if it's around 400, 450 crores. Even if you account for inflation or whatever, you're talking about an increase of a magnitude of 100 times, which is much more than we could visualize. So clearly what you're seeing here is an impact on the stock markets by making them completely dependent on what is happening in the West. At the same time, your ability to reach out to foreign buyers, also foreign investors, automatically declines. That also has become a critical factor. A second kind of effect of this, in addition to the effect on the stock market, has been the effect on the rupee. There is a direct effect in the sense that once the stock markets collapsed, the foreign institutional investors pulled out their funds, and as they pulled out their funds, the rupee collapsed. But there was also an indirect effect in the sense that when the value of the rupee was collapsing, it meant that what the people got out in terms of dollars was declining rapidly. So to continue to hold on to money in India became a curse, even if your company was doing well. So you had that leading to a greater outflow of foreign institutional investment, and that meant the rupee would fall even greater. There's probably the true impact of this is perhaps not recognized because no one remembers the value of the fact that we did not go in for complete convertibility for full convertibility. Because if we had gone into full convertibility, this is the kind of rapidity of decline that we have seen the fall in the value of the rupee comparable to what had happened to the baht in the Asian crisis, when it fell by 40% in a day. Here, since it was only the FIIs, it fell by 25% over a month because of your high growth rates. And at that time, a lot of industrialists decided they would try to hedge their bets and get a long-term kind of hedging agreement, buying up more dollars than they needed. But after they bought that up, they suddenly found the rupee value collapsing. Right? And they were left with something that they couldn't quite sort of manage, where they committed to buy the dollars, and when they're committed to buy at a particular rate, and the rate changes dramatically, they're clearly in trouble. So you had the problem with the stock markets extended to the forex market, and of course you had a direct impact on the export industry. Right? You had a situation where there was an immediate decline in demand in the foreign markets, whether it was the IT industry, whether it was the gems and jewelry industry, or whether it was the garment industry, where essentially the Indian garment industry, for instance, has been a manufacturing unit for foreign brands. Typically, they come here, decide what brand they're going to, what are the conditions, what's the design they want, they give the design and they break it from here. So the moment foreign retail sales drop, automatically the demand for garments also drops. And together with that, on the other hand, you had a kind of a buffer coming in terms of the rupee value falling, which meant that you had lower costs, you became more competitive. Right? So you had two kind of effects. One, general decline in demand, but within the general decline, because of the falling value of the rupee, you sort of tried to remain where you were. And the effects on industry, which is now beginning to be seen, was kind of mixed. If you take the IT industry's results that have come about, you'll see that a company like Infosys has grown by 30%, its profit and its growth is by 30%, but in rupee terms. If you do it and look at it in dollar terms, the growth drops to just 7%. Right? It's still better than some other companies which are growing by 7% in rupee terms itself. Right. So clearly the idea that a lower value will make you more competitive is a kind of touch and go. Not everybody is able to make use of it. Some are and some are not. Right. To add to this, you have the indirect effects that come in. The first, of course, is the slowdown in demand. Because if the IT industry, for instance, is one with high paid labor, if there's any kind of slowdown, or even if not a slowdown, even the fear of a slowdown, it is enough to stop long-term investments or long-term buying. And that we are seeing on a fairly kind of substantial scale. Many cities are beginning to see a substantial decline. Largely because what you have, I think the economists or those who have done economics here would know, is what they call the multiplier effect. That if I spend a rupee, that rupee becomes somebody else's income. They will save some part of it and they will spend, which becomes yet another person's income. The person who takes it again will save a part and spend. So you have a multiplier effect when you're spending a rupee. Similarly, when you stop spending, the same effect works in the negative sense, in sort of an exaggerated way. So you're beginning to find a slowdown in demand, which may be somewhat larger than the initial estimates were of the. This slowdown in demand has been accentuated by the fear that has come into banks that they could all collapse. Though the Indian banks by themselves have not been lending like the American banks, there's been a general fear in the banking sector that's making them very, very risk averse, which means that they tend to give fewer loans or make it more difficult to get loans. And if they make it more difficult to get loans, you end up with a situation where money once again is less in the economy, demand is less, and you're pulling it down further. So you have a situation where banks have become extremely averse to lending, and that risk aversion sort of comes on top of a decline in foreign funds, right? Because for companies now to tap foreign markets, whether it's ADRs or anything else, has become that much more difficult. So the question then is what can be done about it, or what are people doing about it, and is that response enough? Let us start with what could have been done in the US. We can begin by just to remind ourselves about the analytical sequence of events. It starts with defaults and foreclosures. It's followed by the bank's assets collapsing. That leads to jobs lost and defaults increasing, and the stock market collapse. This is basically the steps that came in. Now, the first step, immediately when the crisis occurred, when the collapse occurred, the government under President Bush decided that they needed to prop up their banks. That if the banks collapsed, the whole faith in the American economy would collapse, and then it will become impossible for the economy to recover. So the first bailout package of $700 billion was targeted primarily at ensuring that the icons of American industry and banking did not collapse. They weren't too worried about industry in the sense that while bailout packages were worked out for the auto industry, they were worked out sort of more grudgingly on lower scale. But as far as banks were going, especially AIG, they were willing to go all out to ensure that that people did not believe that their entire financial system would collapse. Because if that happens, already the United States people don't save enough. And if you have a situation where people are not willing to save, whether you don't know what will happen to a banking system, it might be the world's largest economy, but it could collapse as fast. So the first step they moved in quickly was to just have a bailout package. They spent about $350 billion. The remaining is still left and is now will be used by the Obama administration. And that has been moderately successful in the sense that they were able to slow down the decline, if not remove the fear of a decline altogether. Citicorp, etc., are trying to reorganize, restructure. They forced a restructuring in the American auto industry, linking their bailout once again to that. So there's some kind of a pattern, some kind of a thing emerging there. The second, once that happens, then the question comes up, are you willing to invest elsewhere? Where else would you go in to invest? Now, you can plug it at the level of the jobs that are lost, trying to ensure that fewer jobs are lost, and trying to ensure that fewer defaults are there. And these are two elements that are part of President Obama's package that he's putting together. He's putting together an $850 billion package, which will be expected to be ready by the middle of December. And he's already got the $350 billion that is there which as a leftover from the original Bush bailout. So it's a large amount of money. It's close to $1 trillion. But you must remember the American economy is a $30 trillion economy. So in that context, you need to see the figures in that context. So he has a choice now of investing in areas that will directly push up jobs, as well as defaults and closure, and in areas that will prevent defaults by ensuring banks get a lower don't push too soon for foreclosure. So these are two elements of his package, but at the same time, he has another element, and that is more in terms of leaning across the aisle to the Republicans, and that is to offer tax cuts. Now, tax cuts are known to have very, very limited effect on demand. The Bush tax cuts, in fact, part of this problem is that the Bush tax cuts did not lead to a higher growth rate and certainly did not lead to higher demand. Right? So you have a situation where tax cuts will not do it, but nevertheless, he promised a certain 30% or 40% will go as tax cuts in order to get Republican support for his proposals immediately. So that aspect will also come in. So essentially, if you see it as direct investment pushing up the economy, American economy, and tax cuts offering some kind of concession for individuals to invest, direct investment is the better option, but it will be limited in the Obama case simply because he needs to take the Republicans along within that. Now, on the other hand, you have the Indian kind of points of intervention that could come in, and there really were three choices. One was the stock market, second was to do something about the demand slowdown, and the third was to remove the credit squeeze. The bulk of the Indian intervention has been at the level of trying to ease the credit squeeze. You've had a large number of monetary measures that have been taken. There's a great deal of liquidity available with the banks. But the question is, will the banks use it? Right? Or are the banks going to lend when they're risk averse, when there is no demand in the economy? No matter how much money you give them, they're not going to be willing to lend. Right? So which has been one of the reasons why the banks have tended to keep the RBI has been pushing hard to try and create a low interest regime. It's not happening all that easily. Banks have been resisting it simply because they remain risk averse. They see no point in lending to people who may not be able to repay. So the strategy itself there becomes questionable. The point then is that if the problem is with the credit squeeze, then you must do something about the demand slowdown to begin with. Right? And it's here that they might need to do more. There is some talk of increasing expenditure. Of course, the fiscal deficit can now be ignored for the simple reason that if I overspend now, and my inflation is already down, my risk of inflation is much less. So I can keep overspending right now to try and boost demand at a time when there's a slowdown. So the second effect is there. They're focusing largely on the rural economy, trying to push that through. And that helps even with the industry, because the rural economy in India is seen in common terms just in terms of agriculture. But it actually acts as a safety net for the urban economy. If you go right back to the textile strike in Bombay, when the strike happened, people went back to the rural areas, and that acted as a safety net for them. Right? They did not have to come back immediately. They could absorb it. That's happening even here. There's already signs in, say, Bangalore of your garment workers going back to the rural areas. So expenditure on the rural areas serves a purpose of not just helping them, helping agricultural sectors that had been ignored earlier, but also acting as a safety net for your urban centers. And so that is another area that could happen, but there's still no sign of the kind of urgency or momentum in boosting that demand of the kind that you're seeing in the monetary sector. So it tends to be largely supply side. And in that kind of a situation, one way out would have been if companies could raise capital on their own directly from the market, through the stock market. But that, again, as we said, the regional stock markets are now dead. So the only ones who can do it are the very large companies, and very large issues require a very buoyant kind of an atmosphere before they come about. So really, unless the government is willing to revive its idea of regional stock markets, do something about it, that too becomes sort of a crisis point. So what we are seeing then is really, if we go back now to the question we started out with, how do we see the response? How do we define our response? I think if we define our response entirely in terms of a single global system, it will be restricted to areas like the credit squeeze or large macro measures of that kind. But I think if we define our response as seeing it as an epicenter, but one in which will throw up its own opportunities, there would be a need to make better use of the lower fuel prices, lower oil prices. There will be a need to make better use of demand management if we were to take it forward. So I think essentially we need to just go back to our basic point that we need to see the crisis itself differently. We need to stop seeing it as a large global situation where we can just sort of go into a hole and wait until it gets over. But we need to see it as an opportunity, as a dynamically changing situation where we can intervene at different points. We can create new demands. We can create new products. We can generate new markets, something in the way that China has promised to do. They say China too has a huge difference between its coastal belt and the hinterland. It's now promising to spend all its money in the hinterland, so it develops the hinterland as well as. And I think this ability to see the crisis as an opportunity is there even in the United States, because Barack Obama is now talking about using that direct spending primarily to build alternative energy. Right, both infrastructure and alternative energy. We are not seeing that kind of a sharp, detailed, grassroots level intervention strategy on the Indian side as yet. We have, as I said, a huge space because our interest rates are high, so you have a huge space to cut interest rates in the banking sector and increase liquidity, but that will mean nothing unless we can increase demand. And the demand can be increased by investing in areas that are a major deficit today. But once again, we're not seeing that kind of a bottom-up kind of an approach in the response to the crisis. I'll stop here. We can go into, for the moment, we can go into any area that you would like greater detail in if you so wish. But I thought, given this rather large canvas, we might be better off discussing this in greater detail.
Let me start with you, please. Yeah, thanks for giving the overview. Two questions. One is
always we get confused when the rupee value falls. There's a hue and cry about the industries somehow bring it back because they say they're losing or they want to lose. But whereas as a person away from economics, I feel because rupee is appreciating, my country is becoming more valuable. This is the feeling which I have. So what is good as an academic perspective? Is it good to have a strong currency or a weaker currency? The next question which I have is, talk about the bubble. So don't we have a like economic forecasting mechanism by which somebody can just warn to say that it's going to happen? You showed a graph where the derivatives are linked. I think there must be a mechanism by which one can forecast. If a housing industry prices are going up unreasonably, it's linked to some bubble coming up. Just like weather forecasting. Are there people working at least in the academic area? There is economic forecasting can happen.
You see, if I could start with the second question first, yes. Most certainly, when the bubble was there right from about 2006, several economists pointed out that it's a bubble, it's going to burst, including Paul Krugman, who won the Nobel Prize last year. So it was known. The point is why I started out by making a distinction between marketing and economics. For an economist, it's okay to say that, okay, this bubble is going to happen. But if I'm a marketing executive and my job and my increments and everything is linked to how much I can sell, I'll always be tempted to think what is important is not that it's a bubble, but when is it going to burst? If I can get away before it bursts, I'm fine. So that element of thinking comes in. The only way that can be stopped is through regulation. Right? And which is why the Bush ideology of ignoring regulation, giving a completely free hand, has been one of the factors that have caused this. Because this particular crisis, there have been crises in the past like stagflation, which did not fit into traditional economic textbooks, in the sense that you had inflation along with stagnation. This is a classic Keynesian kind of a crisis where prices are falling and the housing prices are falling, so is the demand, the economy is slowing down. So everything is perfectly consistent. So this is not difficult to predict, right? And which is why it might be easier to recover from than we realize. Because if that kind of heavy dose of investment does go through for the first time, in the United States, there's a great deal of, there is a consensus on the investment that must go through. Even the Republicans, who have traditionally been for the free market, are the ones who had the first bailout. So you have Barack Obama going through perhaps the biggest process of governmental expansion in the United States, at least since the 70s, possibly earlier. So you have a situation where this could recover quickly, but the point is that just knowing about it for an economist, for a regulator is fine. What you would say is perfectly acceptable for a regulator. But if you leave it to the market, there will always be individuals who think that let the other guy stop, I can get out before it bursts. And that's the kind of thinking that's the kind of thinking that I promise not to go into Satyam, but that's the kind of thinking that was there even in that case, that if you could borrow something for a short time and you get out before the bubble bursts, you're fine. As far as your first question goes, I think most industry would be happy with a stable rupee. Though industries, the normal thing, of course, that if I'm import dependent, I want a rupee value that is strong. If I'm exporting, I want a weak rupee because I can get the benefit of that. But normally governments try to target a kind of stability so that everybody knows where they are when they enter the market. So out here, really the idea is that even when the rupee was appreciating very rapidly, even then there were concerns. And now when it's falling very rapidly, there are equal concerns here. So.
Next question now.
Mr. Govardhan, please.
Sir, you talked about the cascading effect what the global economy has had on our country. And as you see, whatever interventions India has taken, finally it has resulted in lesser growth rate and also lowering of the inflation rate. Now, is it a realistic situation that the inflation rates are coming down, or do we expect the trend to change when the economy starts picking up in the future? And second thing is, you talked about focusing on the rural economy. Does India see this as an opportunity to do something in that area, and how can it do this? And because that's the economy that has not developed at all for quite some time.
See, as far as the inflation rate is concerned, a part of it is cost push, which happened when the oil prices shot up and oil prices reached $147 a barrel. You clearly had a huge pressure. I think, I don't know if there's anybody from Ministry, there's some people from HP here, maybe you would know better, but essentially I think the current pricing is based upon $60 to $65 a barrel. Right? Now, since it had touched 147, you would need some time to get over those losses with current price, and then you can bring it down. So the cost push kind of factor that you have would tend to decline. As far as the other element, the demand pull kind of effect on inflation, right now demand is down, so inflation is down. When demand increases, you can either have higher inflation or you can have higher growth. Because if I can meet the demand through more products, prices will not rise. It's only when I cannot meet the demand through more products that prices take off. So the question is that, am I going to keep the economy in a way that it can respond quickly to that demand? And this has been the primary concern of the RBI. And one of the things that we don't always recognize is that probably one of the reasons why we have focused on the RBI might be the Prime Minister's preoccupations, because he's by training a monetary economist, and his PhD was considered a very major work. He did it under IMD. Little himself is a very major economist. So though he tends to underplay his economic credentials over the last 2 decades, that would be at some level, I presume, at the back of his mind. But another reason why people in India tend to look at the RBI first is because of its exemplary record in inflation management. If you look at the RBI as opposed to central banks across the world, other central banks have had periods when they have got caught up in ideology in some level. You had the whole monetarist thinking in the United States, where they ended up using only money supply to control everything. Right? Or you have the Keynesian opposite who look at fiscal policy and tend to ignore money supply. The RBI, on the other hand, has always been cautious and been willing to take whatever could be used. And I think the classic example was in the 1970s, when you had the whole Western world arguing very strongly for going in for heavy borrowing from the United States. Right? This is what Brazil did on a very large scale. The entire Latin American countries did on a very large scale. They overborrowed, and then they couldn't repay. In the first stage, the United States tried to protect them by creating international commodity agreements. For instance, the International Coffee Agreement was one in which you had this whole, they fixed a price band, right? So you had the 2 largest buyers of coffee, United States and Germany, deciding that there would be a price band within which they'll keep it, because they wanted to protect the economies of Colombia and Brazil, right? If that did not happen, the banks could get hurt. There's, of course, the additional thing in coffee that if coffee is allowed to decline or die out, the land shifts to coca, and that becomes a drug problem, accentuates the drug problem. So they were willing to work on it on that basis, but even that did not work. And finally, you had a situation where the Brazilian finance minister got up and said that if I had a debt to the United States of $1 billion, I would be worried because I'd have to find ways of repaying it. When I have a debt of the kind that I do, I don't need to worry because there's no question of my repaying it. So it was only when it reached that stage that the entire Western thinking also turned. And then you had people like the World Bank commending what the RBI was doing. In fact, if you look at the World Bank reports in that period, you can see the whole thing. First of all, they were attacking the whole Indian strategy of not going in for that, not being open enough, not benefiting from that. And by the 1980s, you find them making boxes of India's success story about the same strategy. So I would think the faith in the RBI is strong and deserves to be strong. Question is that enough? And whether we're not doing anything else. Your second question was on the rural economy. And I think there we need to just keep in mind one set of very simple statistics. The share of agriculture in national income has dropped to from about 44% at the time of the reforms to about 16 to 17% today. Right? The share of the population dependent on agriculture has shown no similar decline. Right, if you look at the census, just rural economy, people in the rural areas between 1991 and 2001, it has just gone up from 72, gone down from 73 to 71 point something. Right. whereas your income has declined tremendously. Right. So now the question is, can I meet the interests of these people, especially their aspirations when they see what's happening in the urban centers? How do I deal with it? Right. Currently, the government has been dealing with it primarily through grants, through MLAs. So what you have done, you have your MP disbursement scheme, your MLA disbursement scheme. So what you do essentially is you create a different economy altogether, right? Which elects your leadership, and the leadership takes state resources and distributes it through grants, through various forms of subsidies, whatever, right? But that's still proving not to be enough. Partly because the aspirations thrown up by urban areas, and partly because you cannot deal, you're talking about 400 million people, and you cannot deal with them purely through grants or through subsidies. So the only way out is really to move people out of agriculture into non-agricultural activities. That does not necessarily mean moving them to the urban areas. Moving them to urban areas will throw up huge crisis of otherwise. But you have states like Kerala, for instance, which have seen one of the most rapid decline in the number of people working in agriculture. It's come to less than 20% within Kerala. And at the same time, it's also one of only 2 states in India which actually saw a decline in urbanization between 1999 and 2001. Right. So those are patterns you need to look at. Kerala, of course, is a different story. It links up to the Gulf remittances, and a large number of other factors come in. But nevertheless, you need to look at similar patterns, and urgently. Because to expect agriculture to continue to support 2/3 of your population is really, no matter how much you put, money you put into it, is really expecting too much. You must remember that the amount of land we have in the net zone area has been constant since 1960s. And the amount irrigation, you can see the kind of trouble any new irrigation project creates, not just from displacement, but also as interstate conflicts, because the water sharing is an issue. So you're reaching the end of your tether on all those elements. Unless we can find a way of moving people out of agriculture, you're going to have a serious problem. It's not going to be easy. You must remember that any movement out of a land-intensive economy across the world in a large country has had huge human costs. The collectivization in Russia was huge. The Industrial Revolution in Europe had huge human price to pay. The wiping out of the American Indian in the United States was a huge price to pay. What happened to Aborigines in Australia was huge. No country has ever managed, and none has managed to do it with a democracy. So that's an idea of the kind of challenge that we really face. But it's a challenge that we may not be able to avoid.
Sir, the advantage of a good speaker is that we always have a very long list of people asking questions. I only have a list of 15 people with me.
My pleasure. I'll be shorter.
Maybe half an hour, so maybe 2 minutes.
Yeah, sure.
So that we accommodate all. Mr. Kailash Nathan, please.
I have 2 questions for you. Is it true that in view of the high fiscal deficit, government's ability to boost the economy by pumping money into infrastructure is not very high right now? That's the first question. The second question is that when do you see signs of recovery in the Indian demand?
No, actually, the fiscal deficit will help the ability to invest in infrastructure, because you can go beyond the resources that you have, and so your resources are greater. Question is, what kind of infrastructure, and are we going in for labor-intensive infrastructure, or at least income-generating infrastructure, which is the kind of thing that would provide the greatest results as far as demand is concerned, and as far as the recovery of the economy is concerned. As far as the second question goes, I mean, it's the kind of thing you're most probably going to be wrong, but I tend to be quite optimistic, because I think it is a situation where the economy, I tend to see it as a patient who's gravely ill, but where the medicine is known. It's not been given in yet in the United States, but it would be soon, I think. And if you could use that opportunity to restructure the Indian economy, meet some of the challenges in terms of agriculture, then you could take off very, very quickly. And in some sense, the crisis also helps remove some of the problem areas in your industry. I mean, like, just a quick, if you take Satyam again, the fact that it is going to be restructured, it makes the whole economy, IT sector much more efficient at the end of it also. When there's a recovery, it should be able to benefit more.
That's answered. Mr. Shinoy, please.
Yeah, Shinoy from Hindustan Petroleum. You showed a graph of federal rate falling and the oil price rising. I couldn't grasp the connection. Could you kindly?
That's supposed to be just a direct shift from financial markets to other markets. So if I have resources in one market which is tapping the federal rate directly or indirectly, if that federal rate falls, I take it out of that market and I put it into some other market, in this case oil. So oil prices then go up.
Just as a supplementary, would the oil exporting countries who have free access to the financial markets in the US, they themselves could be putting the money? Because that helps the
Yes,
oil market.
yeah, there's always...
Because more than terror, my link was that OPEC countries themselves were playing with the money.
Yes, they always have. There's the whole idea of a petrodollar, and which is why the OPEC was always, in fact, the argument is that the US itself will not want oil prices to fall below a point, which is why when they went into Iraq and everybody expected oil prices to collapse, they didn't. Because the two markets are closely linked. And that's the whole point since 1985 in particular, after the speculator derivatives sort of cut across all markets. What the idea of seeing them as completely independent is no longer a useful analytical tool. We have to see the interconnections, and the players in the interconnections are not just, as you said, speculators, but include the petrodollar, as it's called. Because if you go into that, it links up to the forex market, it links up to the rise of euro. It's obviously a larger and more complex story. But I just like to leave it at the fact that they are closely linked.
Mr. Pansali, please, statement over there.
See, with the global financial crisis, many economies were swept off their feet. But relatively, India has a good job, and Indian economy has not been affected to the same extent. What are the most important reasons for that?
Well, if we look at it in terms of, as I said, epicenter and effective linkages, the areas that were very closely linked was affected as dramatically. The Bombay stock market collapsed dramatically, almost as fast or even faster than the New York Stock Exchange, from 20,000 points to 10,000 points. The fact is, large parts of the economy were not linked directly to a single market. You had a large European market for the garment industry. The IT industry was also already looking to sort of protect themselves by looking at multiple markets. So you have the fact that your exports are just 15% of the Indian economy. So there is a domestic demand. But one must guard against using that 15% figure as a sign of India's exposure to the world market. India's exposure is greater than that because of the money. You have to use the foreign, your current account deficit and how rapidly that's growing as an indicator of that. Right? But because FII money coming in, other things coming in, which are not directly reflected in exports, but are closely linked to what's happening there, or the ability of Indian companies to tap foreign institutional investors, or even tap foreign direct investment, all that affects the Indian economy, which is not captured by an export number alone. But nevertheless, I would agree with you that your exposure to the global market is much less than say, a country like certainly Latin America. Possibly even less than China. It depends upon what we make of it, because the rest of the economy is globalizing, and if we are going to take the kind of set targets that are as ambitious as we have, we cannot do it on the basis of domestic economy alone. We have to link up to that. At the same time, there's a vast, if you could manage the transition away from agriculture with a huge amount of funding, generating demand, it calls for very innovative and thinking that's never happened in the history of the world before, to do that in a democracy. But technically, it is an opportunity.
However, Mr. Sudhanshu Pathak,
to a certain extent, you answered my query in the last question. But at the beginning of your talk, you made a remark that US sneezes, the rest of the world catches cold. Now, one view is that the US, being the center of economic activity, what we are seeing today is that the economic activity in the world is shifting towards the east, to India and China. Now, while China is more dependent on the export market, but if you compare the two countries and you look at the GDP curve, both are on the upward direction. But there is another curve which you look at is the employee remuneration, or what the workmen are earning on an annual basis. If you look at that curve, which is far steeper than the GDP growth rate curve, which indicates there's a huge amount considering the population which is there in India and China of huge purchasing power. So do you agree with this view that what we are seeing possibly is a shift in the economic activity in the world?
I would be, no, I'd like to agree with you, but I would still be skeptical on a couple for a couple of reasons. One of them is that when you look at the growth in income, you have to see how much of that income is directly related to the American market. Right, if I say IT industry and has grown, the income has grown, but if that is dependent on the American market, then unless that market recovers, you are not going to recover. Right, so in other words, your rapid growth is linked to that rapid growth, so the chance of you overtaking them is that much less. Right? The other thing that one would need to keep in mind is that you're really dealing in India with increasingly two distinct economies. In fact, what you're seeing, the whole argument of a political class that's catering to a rural economy through resources that it gets from the urban economy, right, is now completely established on a very substantial kind of scale. Whether that can take the strain of just one section becoming completely integrated and leaving the other section out. Right? I'm not so sure that would happen. That will create tensions of a different kind. You're seeing those tensions in the political sphere. So you would need to manage that along the way. So yes, on one side, Indian economy is stronger than it's ever been before. It's more integrated with the world economy. It has opportunities. But have we done the little background work needed to ensure this is a smooth process? I'm not so sure.
Mr. R.B. Srivastava, please.
Thanks for giving us the clear indication of the present scenario which is going on. The first point which you raised at the beginning of your lecture, that at the end of the day we should be able to look into whether it was a system collapse or it was a temporary phenomenon which will take its own course of time to come over. I think we are debating that issue, and in respect to that, further continuing, if it is so that the system needs some correction, there is a need that the economic reforms which Government of India is doing all the way now, will continue for some time, do we have to have a relook into it for some mid-term corrections? And number two is that as one of my colleagues has said that the Indian economy has shown strongness. One of the reasons it is being talked about that people have been doing by nature they are savers. A lot of investments are being done. People in general keep their savings as a top priority. So if it is so, why the government doesn't motivate for the common investors to increase their investment so that in any future such crisis, the economy can be stabilized?
No, as far as the reforms go, I'm very much against using reforms as a single package, as a term covering a single package. Right? There are reforms that are good, there are reforms that are bad. If you look at convertibility of the rupee itself, I think partial convertibility, the convertibility on the trade account was essential to smoothen out the process of trade. But as I said, full convertibility would have been a disaster and would still be a disaster. So I think we need to look at individual reform measures, and that's why I say I personally I'm not comfortable with the system-based approach. I would like to see it in terms of individual processes that are taking place, which are having their effects, and seeing which effect I should accentuate and which effect I should try to control. So even looking at reforms today, I don't think this can be taken as a statement for or against reforms. I think we need to see some elements have to be strengthened, some defenses have to be strengthened. At the same time, you might need at this time to go abroad a lot more. I don't know about the insurance sector. This might offer you opportunities now because the American and the Western economies are not able to invest elsewhere. So this might be the time to go out as well in some other areas. So I would, each of this is debatable, but I would only request a debate in which we are looking at individual instruments and deciding on it, rather than taking a blanket for or against reforms position. As far as the savings rate goes, yes, I think the government has done a lot to try and encourage the banks to lend, because the whole idea of lowering their various ratios gives them greater liquidity, which they can put in the market. But that will only happen if people think investment is viable. And that in turn requires a sort of revival in demand. So I would think the first sign that that might happen could depend upon what happens to Barack Obama's 850 billion package. If that begins to show signs there and that brings back retail within the United States, that it'll have an immediate impact on areas like the garment industry, and that increases confidence, and that goes on from there.
Mr. K.P. Science, please.
See, my first question is related to regulatory agencies. You have had SEBIs, and I'm sure in Ministry of Finance or Ministry of Economic Affairs or Company Affairs, there must be such watchdog mechanism. Isn't this coming? Didn't they want the government to announce?
Of the stock market thing, what's happening in the US, the regulatory mechanisms are still, to my mind, still in a state of development, and they're largely looking inwards, which they have to, because bulk of the problem is here. This was something that happened outside.
So do we now need to build up stronger regulatory mechanisms?
Yes, but I think the greater failure, to my mind, is you allowing the regional stock exchanges to collapse. It's not just the regulatory mechanisms are important for things like Satyam, though virtually Madoff and others have shown that no matter how good your regulatory mechanism is, there'll always be somebody who will find a loophole in it. Right? So that element, I'm not saying that's foolproof. You need regulatory mechanism, most certainly, but it won't be foolproof. But more important is, are we tapping all the other opportunities? And the link to the earlier question about savings, are we doing enough to look at localized savings coming to local industry? There'll be somebody in the Northeast, say for instance, who has a great deal of great reputation as an industrialist, who we don't know about in Bangalore. Now to put that person, expect that person to come into a national market to raise capital is quite unfair. Right? Whereas in a regional market, there'll be credibility. He'll be able to raise something enough for his own activities there. So the regional stock, the death of the regional stock exchange is a very, very serious.
My second question is related to agri.
Yeah.
You have rightly said that we have not seen any increase in the area under cultivation over the last 20 years.
Net zone area, yes.
Now, on the other hand, we are seeing more and more rural people moving out to other areas. There is a lack of agricultural labor, shortage of agricultural labor, and so on. Now, if you see that, how much time will it take for the Malthusian predictions to come true? Because we are seeing yet another phenomenon. A lot of cultivable land is going into housing for the elite and the rich people, and the SEZs coming up. Don't you think that in the long term it will have adverse effect on all?
See, I think the kind of land we're talking about for these things in terms of sheer magnitude is not enough on its own to create a crisis on the food front. Particularly if you acknowledge the fact that theoretically or in terms of lab productivities, you have the capability to increase your productivity by a factor of 2.5 in most food crops. So the Malthusian thing, I wouldn't be, that kind of an extreme, I wouldn't be so. But yes, there is a problem in the sense of how do I manage that food? The traditional system of managing your food economy has collapsed. If I can take a minute on this. You see, during the Green Revolution, what the government did was it took away the entire risk from the farmer. The government gave you a loan. You bought the technology from the government. You put it in, and then when you had a higher output, you went back and the government procured a product. For rice and wheat, at least, they did that. So you did not have risk at any point. Now that system works as long as the government can sell what it procures in the public distribution system. But if I have a deficit, I can sell what I procure, I have no problem. But once I become a surplus economy, I can't sell. So I end up with huge stocks without being able, which then becomes my subsidy, whereas actually nobody is benefiting from subsidy, it's just going to rats or other people, because you don't have the ability to store it. So then you begin to slow down on that. Then the farmer gets to face the risk himself. And that's part of the problem, because he's not used to the risk for the last 30 years. He takes a loan, suddenly finds that he's investing a crop because the price is high. A lot of other farmers are doing it across the country. By the time the harvest comes, that price has collapsed. There is so much more in the market. And without any mechanism to deal with it, you have an increase in farmer suicides. Sorry? Right, whereas, right, I don't think you can, the way out has to be two things. One is a meaningful futures market, right? Essentially, as I said, a meaningful one that I can put, I can go to a futures market and say, you give me this price, so I know right in June if I'm a kharif farmer, what crop I should invest in, right? But a futures market that's dominated by speculators will take it away again and stop it from playing this role. Right, so I would argue that you need to redefine the public distribution system, maybe the FCI itself, to play the role of guaranteeing prices with a limited role for speculators, with highly regulated role for speculators. That's one way of doing it. The other way is, of course, to go back to the earlier question of getting people out of agriculture. So that actually a number of people dependent on a unit of land has doubled since the 1960s. So, their earning per person declines. When we talk of agriculture as benefiting, you're just talking of prices or a subsidy given. But the point is that they're all dependent on just the same one unit of land. And if that is doubled, they have to generate that much more income.
Gentlemen, we might have to hurry a little bit. Mr. Ramadas, please.
In fact, related to India, you have already covered. Nevertheless, to give a comfort factor with the GDP of projected 7.7 from original 89, will the demand again will pick up in the next couple of months? How do you think the projection for 09, 010 is likely to be?
No, the demand would depend upon, as I said, whether there's a change in the structure. I was talking to Mohandas Pai yesterday after your talk, and he expects the same demand to revive by the end of the year. But it wouldn't happen for garments, is his thinking. I'm not so sure. I think it depends on what patterns emerges from the US, as well as what patterns emerge from government spending here. If the rural spending comes about in next month's budget on a very large scale, then you could see a growth in a number of industries that are currently not growing rapidly.
And my second question is relating to the US slowdown. The impact of China, in fact, China has a pile of dollars.
Right.
How that part we have not covered, that has a direct impact because the slowdown, now the 700 billion bailout plan, whatever, a capitalistic society moving towards a socialistic pattern to give a subsidy in some pattern, keeping the money somewhere else. How that cycle operates is not clear.
See, basically what happened was the Chinese have been exporting to the US, they get a certain surplus, and then they lend it back to the US. Right? So you create a government bond or whatever within that. That's essentially the mechanism. So a complete collapse in the American economy affects first of all, the demand for Chinese goods, which has an indirect effect on India as well, because you have the demand for metals declining. You had a huge growth in, say, iron ore, which has had I don't know if anyone's from Karnataka here, but there's been a group of politicians who have risen completely on the growth in the iron ore industry. That has got into a decline. So you have those kind of linkages there. But as far as China is concerned, the revival of the American economy is even more critical for China than it is for us. So this is why...
I'm saying vice versa. The impact of US slowdown in the absence of China's help, how that slowdown they will resolve. Because they are sitting with $700 billion.
No, the slowdown ultimately is in the real economy. It's not in the financial economy. It is in the financial economy, but as a result of the real economy. So unless they recover in the real economy, then if they recover in the real economy, the demand comes up, they demand Chinese goods, the Chinese supply, the whole earlier system gets back into place. But the solution has to come in the real economy. I don't think they're looking for a financial solution quite correctly.
In the context of what has happened in the Clinton-based rural push for the rural housing sector, we had some time back a issue of loan mela being dished out. Is there a parallel between these two, and are there any lessons to be drawn, not to be drawn into this policy push sector?
Yeah, there is a problem always when you go into a loan mailer or an equivalent in the American housing thing of unsecured or subprime loans, let us say. There's always a problem. Question is, correct me if I'm wrong, but I think the government here at various stages supported the banks or sort of protected the banks from the full effect of this loan mailer. Like even here when they wrote off farmers' loans, the government stepped in and funded the banks. Right. So it was seen as just a short-term welfare measure routed through the banks. That's not the same there. There the banks were just encouraged to just go ahead and do it, and they took the full sort of brunt of the decline on themselves. So what, of course, you can argue the bailout is now their way of doing the same thing that the Indian government has done. Right. But whether it's large enough, or I think a certain amount of regulation deciding who could get a loan would have had a much more stabilizing effect. But if you were looking at the basic idea that these kind of loans hurt the banking system, that's true.
We have your nameplates in the horizontal mode after the questions been answered. That's the story. So next is Mr. Amarjeet Singh, please. So you have said that the holding was the cause of this only in America, that problem is not. But I want to ask you something. America has been involved in a lot of wars, Iraq war, Afghanistan also. And they were fighting those wars for very far distance. They lost a lot of money in those wars also. So how far those have contributed to the situation in the global crisis?
See, what the Americans spend on the wars technically benefits the economy, because that amount of investment is there, that amount of demand is there, that keeps the economy going. In fact, one would argue, if you want to be very, very skeptical, that if the Americans pulled out of Iraq and Afghanistan, they wouldn't get rid of this, they wouldn't revive that easily, right? But I think that one of the reasons might be a reason why Obama is talking about just, what he's talking about really is just shifting from Iraq to Afghanistan, rather than a complete pullout. So that is an issue there, though there is a question, all right, if not the wars, maybe they could have spent somewhere else. Those kind of choices come up. But the wars themselves rarely pull down an economy in terms of stimulus for growth. In fact, people would argue that it took the Second World War before the Great Depression ended. Well, if it's a speculative kind of element as to what that money is, some of it is you take it, you lose it in terms of it's a notional value of that share. It's lost at a level of a notional value. It's lost in terms of the financiers who had that money, right? And what they may have done with that money. It's been lost there. But just as you make money when you speculate and say people are willing to buy it, they're transferring money from other areas to buy your share. When you sell it and the price falls, you're losing it at that same. Person who's doing that transaction loses. So it depends on who it was. If it was the stockbrokers, fine. It was sort of the criminal networks around the world, that's another factor. Or it might be the terrorists. And different networks have been involved in the speculation. They are the ones who lose them immediately.
Dr. Saad, so if you can be just short and brief.
Maybe if you can give us the hard copy of the presentation, it's quite a good one. Where did you get the $3.3 trillion US economic figure from? Is it from World Bank?
This actually I picked up from Krugman, but he's normally very reliable in his data. $30 trillion is an American. I pick it up from Krugman.
And the other one is, do you agree with the former chairman of Alan Greenspan, who sent a subcommittee saying that this is a phenomena once in a century? Or is it the same?
No, I'm sorry.
Sorry, I didn't hear that. You know, Alan Greenspan, the Senate subcommittee said it's once in a century phenomena. Or was he covering himself up because he was instrumental in bringing about this downfall?
No, I think Alan Greenspan is certainly covering himself up, because by allowing the interest rates to drop to close to zero, he had completely removed one whole instrument of government policy. See, out here, in fact, in India, all you're doing is functioning with those interest rates. And you could argue you could have used other instruments, you're not. But you still have, even after that, you have so much more leeway to function. But in the United States, by bringing it down to 1%, I think it was. And once you do that, you've closed that option completely.
Mr. Gupta, please.
I had a clarification on your speculator operation. And I could not understand how it can become larger than the system, which you gave as an example of Bank of England.
Speculators can become larger simply because they are dealing entirely after a while with notional kind of resources. So in fact, the total amount being speculated today is larger than the world economy. So it's because you're functioning. I'm going to buy a 100 rupee share, I say, then the same person buys that share again tomorrow, or somebody else buys it. So the same share, suppose I have a 1,000 rupee company, right, with 1,000 rupees of shares, right, and those shares keep getting bought and sold continuously during the year by different people putting in the money. The notional value in the speculator market, the amount traded in the speculator market, is much higher than the basic value.
But a system cannot put a check on that.
You could. You see, the question is what do you do with speculators? One of the issues this crisis has to answer. I said the idea that you do away with them completely will not work because they're the only ones who are buying and selling risk. So if you can find some way in which they can buy and sell the risk of people who don't want to buy and sell it, it's fine. But if you allow a free hand the way it has happened now, it gets into serious trouble. Because there are two issues that come up in regulating them. One is, do we need to regulate them, which I think the answer is yes. But the second is also, how would you regulate them since they're all functioning globally? Right, and where you need to check where that money comes in. What Dr. Manmohan Singh suggested in the G8 kind of meeting, and which I think was received very well by Sarkozy and some others, is that you do need fresh thinking like Bretton Woods, which would create a fresh mechanism that would deal with all financial flows, tracing them not just in terms of derivatives or what's happening in the markets, but also in terms of the origins, which would give you access to terrorist funds, criminal funds, etc. That kind of.
So we have three more people. So Mr. Srinivasan is there, Mr. Shah is there, and Dr. Samathanathan is there. So if we can have just three of them. Somebody there also? Sorry, I can see. And of course, Madam is there. So we can have the questions in the first instance, and then because the time is running out. Sure. So we start with you, Mr. Srinivasan.
Okay, this is about this subprime lending, because of which Lehman Brothers collapsed. Now, we all know that Indian banking model is sound, so such a cascading effect has no place. Like this problem, there may be many more skeletons in the cupboard. So, how to identify those things and how to insulate the Indian market from this? Is it possible? We have become global. Is there any possibility like forecasting, okay, these are the bubbles that are going to burst?
The next question now again from Mr. Shah, so can all be connected together.
Power Finance Corporation. My question is related to the stock market intervention. So what kind of intervention, can please elaborate that? Then we learn that the stock market investment is a risk investment. Further, we know that Government of India and RBI has bailed out the mutual funds and given them support, etc. So when the market was going up to 22,000 points and the mutual funds people or stock market investor, when they were getting benefited from the stock market, that time nobody has talked of giving, sharing their profit with every one of us. So I am having apprehension because of this tax money going to the supporting to the stock market. Will be every one of us who has not invested in the stock market will be suffering because the high tax rates which we have to pay, our provident funds rates may be reduced, our LIC bonuses etc. may also come down because all are putting up their money in the stock market. And the dirty money, I'll also like you to how to stop that, if you can share your view.
Dr. Samanathan, please.
Sir, myself Samadhana from Department of Science and Technology. You know, sir, now in USA, due to this problem, many academia are not getting R&D projects. You know, there is a lack of attraction in academia for research. Okay, so that scenario, if you look into our country, you know, in India, almost 80% is owned by government in research, R&D. So, should we, increase our investment when other countries are in recession, our economy is somewhat good? You know, what is your view that our country should use this opportunity not to reduce the R&D budget, and even encourage industries also to keep up the pace, because innovation is there, like people say. Another thing, sir, general question, is it the right time to buy house?
I think we can have that discussion outside. Anyway, and last but not the least, Mrs. Reddy, please.
Sir, I'm Anuradha Reddy from the RDO. So you, very briefly, you talked of Bush tax cuts, which led to a rollback on health, on state works, invited Katrina, had a global financial crisis, the repercussions of which were felt in India. We have honored Paul Krugman with the Nobel Prize. I just want to know, what is the role of economists? A year ago, you honored an economist with a Nobel Prize who's predicting a doom. Do we honor people who predict doom and not take any interventionist action as with America, and what do we say about ourselves? We talk.
Sorry, I didn't know.
So thankfully the last question. So I wanted to ask you, this global crisis is an outcome of greed, speculation, lack of regulation, as you rightly brought out. And we were talking about, sometimes it was mentioned regarding decoupling of the economy, Indian economy. Of course, I understand that is not possible, of course, it's post paradise, you can think that. But how far can we insulate our economy from this kind of crisis which is already occurred, and what are the lessons that we are taking us?
Thank you. Actually, I think we can just, they all fall into one kind of a pattern. So if I can start with the question that was raised just before yours, and that is that what is the role of economists when they are spotted at this? I think the main idea is that you need a regulatory mechanism. You need a regulatory mechanism that is consistent with the requirements of the time. Let's remember that the Bretton Woods conference itself, when Keynes pushed for it, he pushed for it on the grounds that the earlier regulatory mechanisms did not stop Hitler. And did not stop Hitler because you had no way of ensuring that you had overall mechanisms, seeing where the money was going, trying to find out how you could control those processes. So in the similar way, today you have regulatory mechanisms. Technically, the IMF is the regulatory mechanism for financial matters. They're not even in a footnote in any of the discussions on financial crisis today. They become completely irrelevant at that point. So you need a fresh mechanism, working out mechanism where the sort of insights of economists are not left to a Nobel Prize or something, but are put into actual practice and taken from there. As far as India is concerned, I think we need, while we need these mechanisms, we also need to get over a fascination with looking at things in terms of systems, in terms of totality. We either go completely with a reform or completely against reform. The term reform itself means different things in different times. When I was in college, reform meant a very left-wing thing of land reforms and things like that. Today, reforms means a completely right-wing opposite. So we need to move beyond these sort of labels and to look at actual processes and what methods we need to take to intervene, which would bring us to the other question as to what are the methods of insulating the economy. And I think we need to look at ensuring, my only suggestion would be that the focus should be on the tools for insulation rather than the insulation itself. For instance, the main thing that's really kept us free here is the fact that we have not had full convertibility of the rupee. That's acted as a very effective tool for insulation. Right? How much you use it, how well you use it, can be decided later. But we need to retain certain tools for insulation. Without making it a question, much of the early debate used to be either convertibility or no convertibility at all. And if you were for reforms and for very rapid reforms, you had to go all the way to full convertibility. Nobody recognized, I think, until Malaysia did it in the Asian crisis, that there are certain things like limited convertibility that you can build mechanisms. In the process of reform, we must not lose the tools we have for managing the economy. And if you do that, I think that's more important than, say, staying out of the economy or staying out of the global sense. So which brings us once again to the question of R&D, because if you're going to do that, then the real issue becomes how innovative am I? And innovative may not just be in the laboratory. It is how I transfer it into actual practice. I can give you just one example. I think fuzzy logic technologies date back to the 1960s. But they really took off in industry only after it was used in the refrigerator as recently as, I think, 2000 or in that time. So it's one thing to know the technology, it's another thing to actually put it and convert it into an economic benefit. And there might be a large difference between the theory or the technology and the actual economic benefit that is there as well. And As far as the mutual funds go, I couldn't agree with you more. I think the argument that what has happened in India is that we have mixed up pension funds with mutual funds. Mutual fund, yes, I don't know how to invest. You please invest it for me and I'll take whatever risk that you say. That's a mutual fund. A pension fund is the kind of stuff that LIC used to do. LIC Invest is one of the largest investors in the stock market, but it gives you a pension fund that's based upon a predefined guarantee. Right? I think it's the LIC kind of investment that has to grow. So that you're using the stock market. Right? At the same time, it is highly regulated and it does not become speculative. So then there's no question, when there's a huge profit to be made, you can build a greater base that protects LIC and protects the pension. So I think really we don't have an effective system of pension funds rather than, and that we need to put in place and put in place urgently. Yeah? And I think that is I think about it, unless there was any other question within that.
Supporting the stock market, mutual funds, are they supporting? Because it is a speculative fund.
Yes, but what's happened in reality is also become a pension fund. So
I think
I'm talking a mutual funds, which is investors have had for.
no, I agree with you. Conceptually, I agree with you. But once in reality, it becomes a pension fund, very few governments will be able to say, I don't care what happens to people who are 65, 70, let them go.
No, when they were benefiting, when the stock market went up to.
So we may have this discussion outside. I believe Dr. Pani is already here in any case.
Right.
So let's conclude the session and then we meet outside. No, we can just continue so that time is running out for the next session otherwise.
May I request Mr. Mohit Khanna to make concluding remarks and also a formal vote of thanks for Professor Narendar Pani.
Thank you indeed, Dr. Pani. The reason that we have overshot ourselves despite running through, I think speaks volume about your interaction, and we're very thankful for that. We have been able to understand the cascading effect of the global economy and effects on India. And India, being a part of the global village, cannot be isolated from the effects. But then it is better to have, as Dr. Saab said, to have our own regulators in place and to have an optimistic approach that we shall definitely get out of it and should not be bothered much about the global slowdown, because the Indian economy as such, per se, is not bad enough. So I thank you, sir, once again.